Hi everyone, this is Devins Financial Weekly Stock Analysis Newsletter. Today is October 30th, 2016. Our newsletter is for your informational purpose only. We're not responsible for your gains and losses. Let's take a look at current market trend and our strategy. U.S. stock market uptrend is still under pressure. Last week, more and more stocks got stopped out, so I'm currently mostly in cash. Let's take a look at indices and their charts. First is the German DAX index. This index is still in consolidation phase. It's kind of uptrend, but in reality is in this flat range with 10,800 or 800 around that age as a top, and here is the bottom. Nasdaq, US Nasdaq. Nasdaq closed below 50-day moving average, and this is not very good with a high volume here. Recently, it closed below 50-day moving average and immediately bounced back, but it didn't reach the previous high. Now it's coming down again. That's not a good sign. SP 500 has been in the 50-day moving average, below 50-day moving average for a long time. It's been since September, it's been below 50-day moving average, so that's in a downtrend. Gold finds support around 200-day moving average. So is the silver, finds support around 200-day moving average. Gold mining stock ETF in a downtrend also finds support around 200-day moving average here. Crude oil is about to roll over here. Crude oil ETF is same as a crude oil. Energy stock ETF and still in this trading range, very slowly going up. China-Asia market in this positive slope. The slope is going up and oscillating around that slow uptrend. China ETF. This is a large cap ETF below 50-day moving average. FXI. This ETF is going down. U.S. biotech index right now seems like it's going down. Real estate definitely in a downtrend. Airline stock are going up. Semiconductor previously finds support around 50-day moving average, but it is kind of weak. Now it started coming down toward 50-day moving average again. We have to be very careful. Make sure the semiconductor does not break 50-day moving average. If it does, it's going to pull down the Nasdaq. It's going to pull down the overall market as well. This is an index to watch for. Social media index is downtrend now. The trend has changed. It's going down. Solar, downtrend. Financial ETF is still in this uptrend. Utility, downtrend, but rebounded from the downtrend. That's the index. We're going to take a look at the stocks, and there are a few lists of stocks. And one is the leading stocks in buy range, which is 5%, within the 5% above a breakout pivotal point. And leading stock that's extended, which is more than 5% above the breakout pivotal point. And the dates here are the earning date for those stocks. We have to watch for earning days because earning days tend to cause the stock either gap up or gap down. Most recently, most of the stocks are gapping down. And then the third list is the stocks that's on the watch list. And again, list the earning date. And then the last list are the stocks being removed from our list. Those are the stock dropped on earnings. So when the earning release come out and something in the earning release, the investor doesn't like it, they just sold the stock. So those stocks being removed from our list, and the chart does not look good. So let's take a look at those lists. First list, stocks in the buy range. And AVGO, this one is already below 50-day moving average. We got to be careful. But previously, every time it does that, it seems to be able to rebound up. So that tend to be a buy opportunity. However, we just have to make sure if you were to buy somewhere, you draw a trend line here. You make sure it does not break the trend line. If it breaks the trend line, then there will be trouble. Alibaba also closed below 50-day moving average, and this $99 is definitely should be a stop trigger. That's the last line in the defense. So if it break below $99, which is a previous low, they find the support there. If it break below 99, that means whoever support the stock around that time and give up. So that's the bad sign. We have to watch and see. We don't know what's gonna do yet. Facebook still in the uptrend. Google also in the uptrend, and breakout pivotal point is at 813 and 98 cents. So around here. PXD also in the uptrend, but also seems to close below 50-day moving average. We have to make sure it does not live below the 50-day. So it has to rebound it in next few days. Now, second list are the stocks that's on the watch list. ATVI uptrend around the 50-day moving average. Earning release November 3rd. Ali May had earning release and the stock jumped after earning release. So this is a good. GKOS, this one, no, this one is bad. This one already closed below 50-day moving average for 2 days. Volume is high. This should be kicked out. This is a stock that we should remove it. PAYC, this one earning release on November 1st, and $51.56, which is above here. This is a breakout pivotal point. TTM, fall below 50-day moving average for 3 days. This also need to be taken out. This is you have to be very careful for this stock. Now, the stocks that's good, but too high to buy. Now, DPZ, this one, Domino Pizza, it gap up after earning release. So this is still in the uptrend. If you have it, hold on. NetE is also still in the uptrend. NVIDIA in the uptrend. This is when they rebound from 50-day moving average, that is a buy opportunity. But if you buy here now, you probably want to take a little profit off the table, and because it's pretty far away from 10-day moving average. So in the past, every time it does that, it tends to drape back and then move up. Weibo, this is a Chinese internet stock, and dropped below 50-day moving average. We need to be careful with this one. Now, the fourth list, we got to pay attention. This list are the stocks that are bad. It's in a cut list. And like ABMD, when they close below 50-day moving average, and that's the bad sign here, then the second day it really come down. And so if you have an automatic stop order, if the stock drops below certain price, it will automatically sell. So you can get out automatically without watching it. And in this market, we really have to use stop order to protect ourselves. But for something, you mean for the earning, you mean a stop order itself may not be enough, like Amazon. And the day before earning, everything looks good, but the day after earning, it just gapped down. So that's if you have stop order, then the second day it will sell, but with a huge gap down. So that can be that can damage your portfolio. So for the stock that's about to report earning, my suggestion would be you have to hedge it. You buy a put option to hedge your long position, or you sell your stock by a call option so that your loss is limited, or you just sell part of your long option, long position. Say if you have 100 shares, you sell 50 shares. So that doesn't hurt. And then if they gap down, then you don't lose much. But if it gap up, of course, you don't gain as much. But still, it's better safe in this market. This current market is not very forgiving. Edward Life Science, again, after earning, it dropped huge. It dropped almost like 20%. And that's a big drop. So stop order will not protect you unless your stop price is around 50-day moving average. You already sold the day before the earning. Then you are protected. If you haven't sold, if you have a stop order somewhere here, then you get to sell with a very low price anyway, so you have the loss. So when the stock about to report earning, the day before the earning, it's a good idea to sell part of it, at least. GKOS, and this one, again, we talk about it, it closed below 50-day moving average. It need to be, it's not a good thing. And GRUB is also job on earning. So those are the stocks don't do well after the earning, and they likely tend to continue to go down. That's the point. Okay. And what to do in this market? And have stop order for the long positions and hedge or reduce the position before the earning report. That'll be all for this week, and see you next week. Please subscribe to my YouTube channel. Thank you.